Welcome you to the other consult platform once again. So today's session will be on Islamic accounting, precisely Sukuk accounting. So in the previous session, we looked at the theory aspect of Sukuk accounting, and we started solving practical questions, and the name of the organization was Aleph Enterprise. So we solved questions on International Financial Reporting Standards. So we are coming to solve questions under Accounting and Auditing Organization for Islamic Financial Institutions, using the same question that we used to solve under the International Financial Reporting Standard. So in the question, the Aleph Enterprise raised finances of 100 million to finance its operations. And then they went into agreement with the SPV, that's a special purpose vehicle, that they were paying annual lease of 5 million. And then when it comes to Accounting and Auditing Organization for Islamic Financial Institutions, that's AAOIFI, for them, they based on Shari principles, that's the Islamic religion principles, and then for them, they prohibit interest. So under the IFRS, we knew that the originator was paying finance expense annually to the special purpose vehicle. But over here, since Islamic principle prohibits interest, what it means is every year that the amount of revenue that the originator will use the asset to generate, they will pay part of it as an income to the Sukuk holder or the investor, or they will pay you to the SPV, and then SPV will give you to the Sukuk holder. So the finance expense that we see in the and under IFRS over here to recognize as a lease expense or lease rentals instead of finance expenses. And then the amount of the lease rentals that the originator will be paying annually was given to us in the question as 5 million. So this is what the originator will be paying. So we start by recording journal entries. Because there is no any finance expenses, so we will not prepare a finance expenses schedule. What we coming to do is only the journal entries. After that, we will use the journal entry to extract income statement and then a balance sheet statement. So the name of organization is AE, that is Aleph Enterprise. So we have the journal and we have date, particulars, debit, and then credit. The amount was in millions. Okay. So this is the format for the journal. On the 1st January 2019, the originator received an amount of 100 million from the disposal of the asset to the special purpose vehicle. But in the books under the IFRS, the originator recorded the asset in its financial statement because of substance over form principle. But over here, the substance over form principle doesn't hold. So we assume that the originator had disposed of the asset to the special purpose vehicle. So they won't recognize it in their books. So the first transaction that will be recorded will be we debit cash of 100 million and then a credit asset of 100 million. And then the narration will be disposal of asset to special purpose vehicle. So 1st January 2019, we have cash and then asset. So they receive an amount of 100 million from the disposal of assets. And then whenever you receive money, your cash balance is increasing. So we are debiting assets. And then since we are disposing of assets, this will reduce our asset balance. So you credit the asset account. And then the narration will be disposal of asset to SPV, that's a special purpose vehicle. Okay. So at the end of every year, the originator will be paying lease rentals of 5 million to the SPV. So the lease rentals will be recognized as an expense, and then since it is paying cash, I mean this will reduce its cash balance. So the double entry will be we will debit lease account and then credit its cash account. So 31st December 2019. So we have lease and then cash. So you debit lease 5 and then credit cash 5. And then the narration will be lease rentals to SPV. So lease rental to SPV. Okay, so the next transaction will be the next year, which is 31st December 2020. And then for the 2022, we also repeat the same transaction by debiting lease 5 million and then cash 5 million. Because they will be paying this lease rentals of 5 million throughout the entire 5 years. So lease and then cash. So for lease 5 million, cash 5 million. And the narration will be lease rental to SPV. That's a special purpose vehicle. And we do same for 31st December 2021. So for this one too, you debit your lease and then credit your cash account. So lease and then cash with the amount of 5 million, 5 million. And then narration, lease rentals to SPV. We do same for 2022. So for 2022 too, you debit lease and then credit cash with the amount of 5 million. And then narration, lease rental to SPV. So 1, 2, 3, 4. So left with last year, which is 2023. So 31st December 2023. For this one, to debit your lease account and then credit cash with 5 million, 5 million. And then the narration will be lease rentals to SPV. Okay. So at the end of the 5 years, there was an agreement that the originator will repurchase or rebought the asset back from the SP. So whenever the originator is buying an asset, the double entry will debit asset account and then a credit cash account. But since they are buying the assets with cash, cash is going out, so their cash balance will be reduced. And then since they are receiving assets in return, the asset balance will be increased. There was an agreement that the originator will rebuy or repurchase the asset at price of 110 million. So you debit assets with 110 and then credit cash with 110. So 31st December 2023, asset account and then cash account. So you debit asset 110 and then credit cash with the same 110. And then the narration will be purchase of assets from SP. So purchase of assets from SPV. That's a special purpose vehicle. Okay, so we are done with the double entries. So we proceed with the preparation of the income statement. So we proceed with the preparation of the income statement. Okay, so we write income statement of AE, that is Aleph Enterprise. income statement of AE. And then we create a column for the years. So year 2, December 31st. And then since we are doing it for 5 years, so there is no need for you to write income statement for the year and the 31st December 2019, 2020. We will write everything all together. So we create a column for 2019, 2020, 2021, 2022, and then 2023. So after this, we create a column for operating income or the operating profit. So for the person, it was stated that AE Limited, that's Aleph Enterprise, made an annual profit of 40 million on a cash basis. So we create a column for operating income or operating profit. And then they paid a lease rental of 5 million every year. So that will be the expenses for the year. So we have lease rentals. So we start by recording the operating profit. Since they made a profit of 40 million annually, means for the various years, the profit are 40 million. So for year 1, 40 million. Year 2, 40 million. Year 3, 40 million. Year 4, 40 million. And then the last year, which is year 5 to also 40 million. And then the lease rentals, they also paid their annual lease rentals of 5 million. So we less the 5 million. So 5 million, 5 million, 5 million, 5 million, 5 million. And then the difference will give us the net income for the year. So the difference will give us 35 million, 35 million throughout. So this will be the net income for the year. So we are done with the preparation of the income statement. We proceed with preparation of statement of financial position or the balance sheet. So we are coming to prepare the balance sheet statement. That's a statement of financial position of A. So we have statement of financial position of A. Position of A, that's Aleph Enterprise. So we have already created a column for the various years, for the 5 years. So in the statement of financial position given to us in the question, the asset column, they were having a building and then cash. So we create a column for building and then cash as well. And then that was the only asset that they were having. So the finance by aspect, they were having a share capital. So share capital. Then also they were having an retained earnings. So retained earnings. Okay, so this is how their financial statement was. So we continue by recording the various amounts in their respective items. So the first item under the assets is building. Okay, in the question, they were having a building that value 100 million. And then this is what they dispose of to the special purpose vehicle to raise up finance. But because Accounting and Auditing Organization for Islamic Financial Institutions doesn't recognize a substance over form principle, because of that, they assume that the organization are disposed of the assets to the special purpose vehicle for money. So since they are disposed of, since they are disposed of to the SPV, they shouldn't recognize the assets in their books. But this time around, the ownership right of the asset has been transferred to the SPV or the Sukuk holder. So it means for the first year to the fourth year, they will not recognize it in their books. It was only the fifth year that they bought it back. So for the fifth year, they will recognize the asset in the statement of financial position. So first year will be dash, second year will be dash, third year will be dash, fourth year will be dash, and then fifth year, which is 2023. They repurchase the asset at price of 110. So 110. Okay. And then for cash, they were having an open balance of 50 million. They were having an open balance of 50 million. So that's 50, that's the open balance. And then they took a loan or they received a finances from the SPV, which was 100 million. So it means the cash balance has been increased by 100 million. That's the amount of money that the SPV gave to them. So plus 100 million. And then from the question, every accounting year, they make profits of 40 million. And then they said that we should assume that all the profits or all the transactions were made on cash basis. So it means plus 40 again. And then every year, they were paying an annual lease rentals of 5 million. Since they are paying annual lease rentals of 5 million, this will decrease their cash balance by 5 million. So minus 5. So 50 plus 100 plus 40 will give us 90. Minus 5 will give us 185. That's 185. And then this 185 will serve as the open balance for the second year. Open cash balance for the second year. So for the second year too, they will make a profit of 40 million. And then minus 5. And then minus 5. So this will give us an open balance of 220. And this will give us a closing balance of 220. So cash balance for the second year will be 220. And then for the third year, they also made profits of 40. And then they paid a lease rentals of 5 million. So minus 5. So 220 plus 40 will give us 250. Minus 5 will give us 255. So we have 255. And then this balance will serve as an open cash balance for the fourth year, which is 255. Then they make profit of 40. Then they make payment of 5 million. So minus 5. And then this will give us a closing balance of 290. Yes, this will give us a closing balance of 290. And then the last year, this 290 will serve as an open balance for the fifth year. So we have 290. And then they made profits of 14 million. And then they paid lease rentals of 5 million. And then don't forget that at the end of the fifth year, the originator repurchased the asset from the special purpose vehicle at price of 110 million. So since they are repurchasing the asset back, this will reduce their cash balance. So we deduct 110. We deduct 110. And then this will give us a closing balance of 215. 215. So we have 215. So you add the building to the cash to get the total asset. Okay, so over here we have 185. That's total asset. Over here 220, 255, 290. And then this will give us 325. So we are done with the asset aspect. Okay, so we proceed with the finance by aspect. So in the question, share capital has been given to us as 120 million. So we record the 120 million throughout the entire 5 years. So 120, 120, 120. And then for retained earnings, they were having an open balance of 30. They were having an open balance of 30. And then so since they are having an open balance of 30, you add the net income. So that's the net income that we had from the respective years to this. Because we know that for retained earnings is a part of the profit that the organization didn't distribute it to its shareholders as a dividend. And then in this question, we are not paying any dividend. So it means that we'll be adding the entire net income to the retained earnings open balance. So for 2019, the net income was 35. So you add the 35 to the 30 to get a retained earnings of 65. So we have 65. And then this balance will serve as an open balance for the second year. And then for the second year, we also made a net income of 35. So 55 plus 35 will give us 100. And this 100 will serve as an open balance for the third year. And the third year too, we also made a net income of 35. And then this will give us 135. And then for the fourth year, this 135 will serve as open balance for fourth year. And then fourth year we made a net income of 35. And then this will give us 170. And then for the last year, we made a net income of 35. So 170 plus 35 will give us 205. So we have 205. We have 205. So that's all for the finance by aspect. So over here, there is no any Sukuk liability. There is no any Sukuk liability since the organization didn't maintain the assets in their books. So you add up the two. So 120 plus 65 will give us 185. And then 100 plus 120 will give us 220. And then 120 plus 135 will give us 255. And then 120 plus 170 will give us 290. And then 120 plus 205 will give us 345. So you can see that the finance by aspect is also the same as the total asset balance. So it means the balance sheet statement has balance. So on this note, we have come to the end of today's session. In the next session, we will solve another practical question under Accounting and Auditing Organization for Islamic Financial Institutions. After that, we will solve another question using classified balance sheet. See you in the next session.